Thank you. Good morning, everyone. This meeting is being conducted via Microsoft Teams pursuant to Section 21-1503 of the Philadelphia Code. Electronic recordings of this meeting will be made available through the Teams conference technology and platform, and an audio recording. Additionally, electronic recording will be made available to the public online at the Commission's website without charge within the next 10 days. Please note that you consent to such recording by attending, participating, or speaking at the meeting. And with that, I will turn it over to Don.
Christopher, thank you very much. I hope everyone can hear me. I am having some technical difficulties. The first order of business is the approval of the January 25th Sinking Fund Commission minutes. Is there a motion?
I'll make a motion, Don.
Thank you. A motion is there a second?
I'll second.
Motion has been made and properly seconded. All those in favor say aye.
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 Thank you very much. Again, let me welcome everyone. And before I move on to the second item on the agenda, I want to make certain, Christopher, that you don't have any opening comments that you'd like to make before we get going.
No, I was just going to make a couple quick comments on the second investment item before I turn it over to Lee and Alberto. I just wanted to note that as of this morning, before the market opening, the total assets in the fund were approximately $664.1 million. That is inclusive of roughly $12.5 million in the employee custody cash account. With that, and hopefully folks can see the documents I'm sharing on the screen. But with that, I'll turn it over to Lee and Alberto. Lee, if you want to just tell me what document you want to use, I'll try to keep up with you and Alberto going through this.
Okay, if you would like, Chris, I can just share my report.
Okay, I will. Yeah, I'll stop sharing then.
Okay. Can everybody see that?
You know, for some reason I can't, but
Let me try a different method here. Why isn't this window coming up? Maybe I don't have shareability. Let me have a look.
If you don't, I will.
Oh, there we go. Let me try that. How about now?
Yep.
Yes.
Perfect.
Yep. Thanks, Lee.
Perfect. Well, I figured I'd start. We're going to cover the February report here, which Chris forwarded over to you. But before we kind of get into the details from a performance point of view, I thought it might make sense with all the unknowns going on and all the uncertainty right now has created some volatility in the markets. So noting later today, Chairman Powell will be talking to, which I think occurred the last time I drove the meeting back in September. But what I'll do is give a bit of color what we sort of expect today and what we're thinking at least as the first half of this year plays out. So if you're following along, I'm on page 5 here, and we'll start just on the more so on just US economy here, and really focus on the two things the Fed are somewhat focused on: inflation and jobs. And as we see here, at the beginning of this year, we did see at least PCE inflation continue to soften slightly. Remember, PCE excludes food and energy. However, in January, if you look at CPI, when you factor in food and energy as well, we did see CPI tick up again a little bit. And sort of what we kind of alluded to towards the end of last year, post-election, kind of what we were suggesting might play out sort of happened. You saw that initial run in equities on the forward of deregulation and tax cuts. However, you saw yield spike in the fourth quarter on the forward of, if we're imposing tariffs, prices are going to go up. it could potentially be inflationary again. So it wasn't a surprise to see that in January, a little uptick. And also, if you remember at the beginning of the year, you often see a reset of prices and rents, etc. So it's somewhat seasonal to see a little jump in CPI in January. As we look here in February, we have seen inflation drop a little. Actually, the annualized rating came in a little below expectations at 2.8%. Really, more so as the consumer has taken a bit of a step back this year. And as you guys know, the consumer drives about 2/3 of US GDP. Now, what I will say is you don't see the tariff implications in any of these numbers that we've seen so far. So I think at this point, it's somewhat unknown what inflation is going to look like, at least for March and April. And I think you really need to understand where we're trending before we get a better picture of where potentially the rate of rate decreases for this year, and then that potential implication on bond and stock markets. So somewhat unknown. Maybe Powell later today will give us a little bit more color, at least at what they're seeing out there. If I go to the next page, oops, sorry. If we look at job openings here, we have seen a strong job market, very resilient job market. And as we sit here today, if you look on the right there, that chart, that there's basically a job opening per unemployed worker currently. So it's a pretty balanced. We're pretty balanced here from a job point of view within the US economy. However, we do expect that to start to worsen somewhat as hiring has certainly started to soften a little this year. And with all the kind of government jobs that are being reduced, we do expect that will kick up somewhat. And again, hopefully today Powell will give us a little indication of what they're seeing, at least in the forward-looking data, that may kind of impact that rate of expected cuts this year. Obviously, if things worsen and employment continues to tick up again, as we're starting to see this year, then you would expect rates may come a little more quickly. And then finally, if we look at expected GDP, we were expecting a little lower GDP this year. But with this weaker consumer spending, again, noting that the consumer drives most of GDP here in the US, we have seen at least Atlanta Fed come out with expectation of maybe contraction here in first quarter and a negative GDP print. And we do expect weaker growth this year. We don't expect, such a significant negative print here in first quarter. We don't believe it is worse as you're going to see here. But again, somewhat unknown with, how long these tariffs are going to be in play. And so I kind of sum up really then, what we expect from Powell today is pretty much we think they're going to continue with their wait and see policy. If you remember, this time last year, we were looking for 4 rate cuts in 2024 with an additional 4 rate cuts here in 2025. By the year end, obviously, we did see those 4 rate cuts. However, the 2 that occurred in the fourth quarter had a sort of the opposite effect, where the yield curve did lift again a little as yields went up. So we ended the year with an expectation of potentially only 2 rate cuts this year. And then at the end of Jan, with CPI ticking up again, that came down to 1 rate cut pushed to late in the year. However, as we're seeing these worsening labor expectations and slower potential growth here, 2 to 3 rate cuts is back on the dot plot, at least for this year right now. But again, there's a lot of unknown with these tariffs. Are they going to be more short term? Bargaining chips, sort of like we saw in 2018, or are we going to see more of a long-term trade war? Again, really going to be riveted to the TV this afternoon to see what they're seeing, at least forward looking. So if we just look at least your asset classes, what has that meant for returns this year? So we'll focus on fixed income to start with, and we have seen after that jump in yields at the end of last year post-election, we have seen yields actually a little lower this quarter, and that's obviously been very bullish to fixed income returns, particularly those benefiting with a little longer duration. So you can see here for quarter to date, the ag has actually been a strong 2.7% return, about 70 bips ahead of the intermediate gov cred, again, because yields are coming down, means prices go up, duration becomes an amplifier of that. However, when you look at that 3-year number, you see that effective tightening in recent years, whereas the shorter duration intermediate gov cred has actually outperformed core bonds, which have been slightly negative over that period as we went through that rate increase cycle. And then the other pivot we've sort of seen this year, you've seen a lot of great return from sub-investment grade over recent years, bank loans through, their not zero impact from the tightening and more of the risk on environment, shorter duration with high yield. Obviously, we've seen that change this year with yields coming down and more of a risk-off environment. As you can see, high yield and both loans have lagged the core bond market so far in 2025. Another thing to note this year compared to what you've seen in recent years, yields are so much higher now, particularly in core bonds. If you look on the left there, ag there 4.6, quite a bit above its long-term average. What does that mean for your portfolio? It means now when we have a little bit of an equity drawdown, like you're seeing over the past month, you've got a bit of yield cushion from your fixed income portfolios this time, which is going to offset some of that downturn in the markets. So actually, when you heard Chris just give you an update on values, you'll see they're not too much different from where we were at the beginning of the month here. And some of that is just due to the more kind of the protected ballast here and the high yield you're getting from your core bonds. And then obviously, if we look at spreads as it relates to more so sub-investment grade, you can see that there was a little bit of spread widening that occurred in February, and I suspect we continue to see that a little bit here in March too, which is why you've seen poorer returns on sub-investment grade this year. But as you can see, those spreads, even with a little bit of widening, spreads are still well below historical averages, particularly for high yield there, which is when you look at your core plus manager, they have very little in spread right now, because the spreads widen. That's going to be, for high yield, that's going to be a negative impact. And therefore, you're starting to see your core plus managers look more like core managers right now. And they will then dial into these sub-investment grades after spreads blow out or widen out at some point in the future. And then final one on fixed for you. Obviously, a big concern now, what we taught the managers is, what are you seeing in the way of defaults, the lower quality type loans. Up to this point, as I said, spreads have been so tight, so no surprise. One bright light in the market is defaults are down somewhat this year, and quite low relative to what we've seen historically for high yield. And but again, I will caution you that we do expect that to somewhat worsen as the year goes on, particularly if we continue to get a contraction and even a potential recession here, if we have this kind of long-term global trade war that is in play. So it's why you see a lot of managers sort of moving up the quality spectrum as we sit here today. So that's fixed income. Just quickly on equities here. Also in equities, we're seeing somewhat of a pivot this year. As you saw post-election, you saw a bit of a jump, obviously in the Mag 7 again, and a bit of a risk-on environment. But as the reality of this impending tariff war has hit the markets, we've definitely entered a negative territory in US stocks this year, particularly in the tech-heavy NASDAQ and in the small cap space, where actually both have entered correction territory at this point here in 2025. So what have you seen? If you look more longer term, if you look at the growth relative to value, at least over 5-10 years, Russell 1000 growth has handily outperformed the 1000 value. And even over the past year, and that has really been driven by that, just the tech ride and more recently that Mag 7 run. But if you look this year, quarter to date, you can see we've seen a big reversal. We're actually seeing negative numbers in the growth stocks as the Mag 7 have sold off, and actually positive return in more of the defensive areas of the market as the market started to broaden, as the expectation of rates continuing to come down. The interest rate sensitive areas are doing much better now, like financials, which tend to be a bigger allocation within the value market. If we look down also now at sectors, again, no surprise to see this year, the three areas that are negative are just the lofty valuations that we began the year in tech, communication services. So that's where you're seeing most of the sell-off this year, along with the more cyclical growth sectors, consumers discretionary. What is doing much better this year has been more of the value areas, such as financials, as I said, and more notably the defensive areas, such as your dividend payers, staples, etc. And you're going to see that in that relative performance of a strategy such as Copeland, which tends to benefit far more from more of a defensive type market. Just quickly on small caps, as I said, they have kind of fell into correction territory here in March. As you can see, this grey line here sort of plummet. If you are expecting it to go into a recession, even a mild recession, it's no surprise you'll see small caps sell off first, and then as you sort of come out of a recession, you'll sort of see small caps lead the way as you come out of recession. So the reason I show you this page is you do have a bit of a small cap overweight, so it'll give you some kind of understanding of relative performance you're going to see here shortly. And then here, just finally, if we look at that Mag 7, obviously the darker brown here, almost all of the Mag 7 outside of NVIDIA benefited in the fourth quarter post-election, all nice and positive. But this year, every stock outside of the internet-based meta stock has been negative this year with NVIDIA, and obviously you see the news with Tesla really being impacted, as we've seen a sell-off and a kind of a risk-off environment, and a reversion to the mean, which we knew was coming at some point in that area. So just to wrap up equities here, it's not only the Mag 7 this year. Any companies that have exposure to supply chains, North America, think of that Canada and Mexico, add into that China as well. With the uncertainty around tariffs, stocks that sort of had some links or lean into those supply chains have really been impacted this year. And that's what this grey line is showing you, this big sell-off in what's known as the UBS Trump Tariff Losers Index. And that is really 38 stocks across areas, such as the autos, agriculture, electronics, raw materials. As we apply tariffs, more often than not, we get reciprocal tariffs back on our goods. And a classic example, as we saw in 2018, of that was soybeans here in the US. As China put on tariffs here for us, the cost of ours went up. They pivoted and went and bought soybeans from Brazil. So again, a lot of uncertainty in equities right now, a lot of volatility. It's just all around the uncertainty with the long-time play regarding tariffs. And then just quickly to finish up for you on international markets, again, a word I've mentioned twice, and I'll mention for the third and hopefully last time today, we've seen a big pivot within equities too. We've seen whereas US equities have really sold off this year, we've seen that being offset by a appreciation overseas, particularly within European equities. But before we go to this year, if you look more longer term, since the financial crisis, our rates have been very low here in the US and really been very bullish and stimulus to our equity markets. So you can see that the US handily outperformed international stocks over the past 15 years. However, the first decade of this century, it was actually the reverse. US stocks lagged international stocks. And what you're seeing here this year, particularly in light of the dollar actually beginning a little weaker now, is you're starting to see stronger returns from overseas. So if you look at the developed markets index, EFA, so far year to date, up 7.3%. If you look in local terms, up 5.8. That means there's been about 150 basis points slide in the US dollar against a broad basket of EFA currencies there over that period. So that's interesting to see. We often get asked, why do you invest in international? There is some diversity. If you only have a 2-asset portfolio, there is some diversification impact by having overseas. And one of the benefits as well is the currency play that tends to amplify returns over relative to the US. From a sector point of view, pretty quickly here overseas, technology, just like in the US, is really the area that's lagging so far this year. And where you've seen a big investment is obviously been in European stocks. As the US are pulling out as support for Ukraine, Europe are really stepping up and increasing their defense spending. And that's what you see with that blue line there. Big appreciation within those names this year. And then the green line is international stocks relative to the orange, which is the S&P. And then the big loser this year is the Mag 7 there, as you can see. The big sell-offs there. So last page for you, and we'll get into quickly into the performance. Just finally, China, as you know, we did see a lot of stimulus applied in China the third quarter. You saw a quick rally for about a week there, and then China sold off again for the remainder of the year. They need so much more stimulus there, and they really need to get their own consumer buy-in again and helping to stimulate their economy. But we have seen a bit of at least through February, a bit of a rise in technology, Chinese tech stocks, really on the back of DeepSeek and the thought of lower cost AI implementation in the future there. But as you can see in March, we have seen that sell off quite sharp. You see that downturn here more recently, and not sure that the legs will be there if we're going to have an ongoing tariff war. So spend a bit longer on the markets than I would normally do, but noting all the uncertainty there, I felt I should cover it a little more deeply today. Are there any questions at this point? If not, I can get into we can get into your funds performance. Let me just maximize that again. So if we look at the beginning of the year, you can see although your policy index for the month was just slightly positive, and again this is through the end of February, you can see that you did lag the index a little bit so far this year. And it really has nothing to do whatsoever with your managers. It really comes down, as you can see in this bottom left corner here. You started the year with a little overweight to equities and underweight to fixed income. So that had the biggest impact on why you're seeing a 50 basis point lag so far in 25. And then to boot, you do have a small cap overweight, and as you heard, small caps have hit correction territory this year. So those are the two factors that are really attributable to the underperformance. However, fiscal year to date, obviously having that slight equity overweight helped obviously last year, and so somewhat offset fiscal year to date. You're about right on the money there. Slightly above your assumed rate of return, fiscal year to date at 7.4, in line with policy. And then if you look longer term, 5 years and 10 years, I mean, you've just had great returns from your fund. A return of 9.7 over 5 years is excellent. 100 basis points north of your bench. And it's one of the reasons why, your funding is much better today than it was 5 years ago, and why you're still going to have some gains in your portfolio looking forward here for a year or two, because I believe 4 of your last 5 years have been well above your assumed rate of return. And so you've got some gains there that the actuary is able to smooth any potential down periods, sort of like what we're going through now. So that's good to see that strong 5-year number. And then just to know what Chris mentioned, we ended February 666 million.
Am I the only one that can't hear him?
No,
Yeah,
I
I
think
think
he froze.
Yeah, I think he froze.
Oh, okay.
Let me shoot him a message.
Hey, Chris, sorry, trying to get a hold of him here as well.
Perhaps give it another minute or so, and if his issues don't resolve, maybe we can pivot over to number 4 while he tries to get his is that him? Yeah, no. Pivot over to the custody bank, and then hopefully he'll get his computer issues resolved. So I'll give it another 30 seconds or so. Just in respect for everyone's time. Yes. Let me share my screen with the report while we wait for him back. Okay, can everyone see that the screen?
Chris, I told you for some reason I can't see anything, so proceed.
Christy, Bill, can you
I-
see the Okay.
Yes,
All
it's
right,
back
so
on.
thank you. So we'll pivot over to the custody bank if that's okay, and then we'll circle back to the remainder of the performance. So as I think most of you or all of you know, the custodians, the current custodian, US Bank, the incumbent contract was coming up on expiration. So last year, we posted an RFP on eContract Philly to comply with the code requirements of Chapter 17, 1400. Posted that RFP for about 5 weeks, and we received 2 responses, one from the incumbent, US Bank, and the second from Northern Trust. And Northern Trust also happens to provide service on the custody side to the larger fund, the city's municipal pension fund. Reviewed each response carefully for compliance with required minimal qualifications as part of the initial screening process, and found that both met the required minimum qualifications. Evaluated the RFP questionnaires, and I conducted multiple calls with Northern Trust and US Bank. Along with Marquette and Lee and Alberto, who were very helpful, especially later in the process. We considered a number of factors, including but not limited to custodial bank experience, their approach and process to securities lending, and their ability to generate SEC lending income, the type and range of the services they provide on the custodial side, the quality of their performance measurement, and working with the consultant. And then on the experience side, again, providing service for clients of similar size and structure to the sinking fund commission. Also consider costs, which we'll get into momentarily, and the firm's overall organizational stability. I endeavored, just because of some of the differences in how the banks tend to present their cost proposals, I endeavored to keep this report relatively short and to the facts, so you can see the overview of both banks, US Bank, again, the incumbent, and then Northern Trust, who also applied. For US Bank, our primary team, Tanya and Karen, would not change. They are proposing again an 80-20 lending split, which we asked for on the securities lending side. They propose an annual relationship minimum of $50,000. And their best, last, and final offer, which is an estimate based on current planned transaction volumes, is around $248,000. That is a decrease of roughly $53,000 over what was paid last year. I would also note that that figure includes out-of-pocket trading fees, proxy fees, and other things that get passed through from managers through the custodian and then were billed. On the Northern Trust side, the primary team would be identical to who we have right now for the Board of Pensions and Retirement. So there's familiarity with staff there. Their proposed lending fee is identical, 80-20 split. There was no change to the proposed fee and the best, last, and final. It's $150,000. However, the main distinction between their bid and US Bank's is that $150,000 does not include costs listed in the other fees and expenses section. We asked them to provide an estimate. They either, they wouldn't do that without knowing more, or they didn't want to make any representations without knowing for certain the kind of volume we'd have on the transaction side. Lee and I and Alberto did some work. We believe that once the fees are passed through, the proxy fees, the trading fees, etc., there is likely to be little, if any, difference between the two proposals. We believe that it will come out roughly, around the same amount, $250,000. I've also provided the employee demographic information for each firm, the demographic breakdown of each firm and board's workforce. While I didn't put a recommendation into the memo because I wanted to have the opportunity to, meet with you and make sure that there was clarity on the fee side. Given that there is not, in our estimation, Marquette's and myself, a great deal of difference between the fees, given the administrative and legal, I'll call it burden or time consumption in moving custody banks, even for a more simple portfolio like this, it is a time consuming and somewhat difficult endeavor, as well as I think the really excellent service and the good relationship we have with US Bank on a plan of this size. My recommendation, and I believe Marquette's, although I won't fully speak for them, would be not to make a change. It would be to retain the incumbent and then move forward with the law department on executing on executing a new contract. But happy in conjunction with Marquette to answer any questions that are outstanding.
But just one question, in terms of Northern Trust, are they the provider to the city?
Yes.
And in terms of quality of service relative to what you've experienced with US Bank, about the same?
Yes, they're both very good. As a matter of fact, and I may have talked about this a few years ago, I know it's been a while, when US Bank got hired, Tanya, at one time, the lead on this arrangement, worked for JP Morgan's custodial bank. They were long ago the custodial bank for the main fund. Staff has a, great working relationship with her. She's excellent. Don, but, generally speaking, Northern also provides, quality service. There's nothing in my estimation, however, that makes Northern's service so much superior that it would compel me to, recommend them over the incumbent.
And the relationship with US Bank goes back how far, Christopher?
At least 4 or 5 years, I
4 or 5
believe
years.
that they were hired as part of the previous RFP. So they're the incumbent, and it goes back at least 4 or 5 years.
Well, I would be inclined to go with your recommendation. So what about the other commissioners?
Yeah, Chris, I just had one question. Can you explain the STIF fee, STIF, and the difference between, why is there such a large difference between the twos? I mean, 0.03 versus 0.10 in terms of this is significant. So what?
Yeah, so that represents the fee that they charge on any cash we have in the overnight account. So the 12.5 million that I mentioned at the beginning, each bank has their own, I'll call them mutual funds. That's not exactly right there. But it's like a mutual fund. It's an overnight account to sweep in cash. You make interest and then the cash is available the next day. Northern, based on, and you have a bunch of different ones you can choose from. Generally speaking, we're going to choose from the most safe and try to get a little bit of yield. There's different versions of that, but based on what we're using with US Bank, Northern looked at what they have that's similar, and the fee they proposed, as you note, Fran, was higher for a similar type account. Given the amount of cash, it's not going to be, an astronomical additional charge, but when you're dealing with two fees that appear to be relatively similar, every penny kind of counts, and that would obviously add some additional cost on their proposal.
And I would just, I I agree with Don. I think we should go with the recommendation and for a couple of additional reasons. I mean, you mentioned Tanya. She was great to work with when she used to be with JP Morgan. In fact, I think that's one of the reasons that the larger fund no longer has JP Morgan, is the loss of that relationship. I think number two, the lack of transparency in the fees. I mean, they required you and Marquette to do some legwork and you don't know. You believe the fees would be similar, but we don't know that, and that is some level of uncertainty that that I'm not as comfortable with. So, and given the difficulty of any transition, I agree with Don to support the recommendation.
So do we need to take a formal action here?
Yes, but I want to make sure that the controller or the first deputy didn't have any questions before we did that.
I don't have any questions.
So yeah, Don, we would need a motion and then a vote before we went back to the rest of Lee's presentation on the investment side.
So is there a motion?
Make a
that we
motion
can
to retain U.S. Bank as the custodian.
take? Is there a second?
I'll second the
I'll second.
motion.
The motion has been made and properly seconded that we continue with U.S. Bank. All those in favor say aye.
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 Opposed? Ayes have it. Thank you.
Thank you. Thank the three of you. I'll stop sharing my screen and then Lee, if you want to go back to where you were and finish up, that would be great.
Yeah, I'm so sorry, everybody. Unfortunately, I'm in the PMRS office today. We're having an education day, and their Wi-Fi went down, but I didn't realize it, so I was still going through the presentation. But Alberto mentioned that we were on the performance page 1. Is that correct?
Yep. You were comparing, I think you were finishing up the fiscal year,
Okay.
kind of the fiscal year versus year to date returns.
Okay. Yeah. So we talked just quickly. We talked about underperformance, at least so far this year, is really just been the overweight to equity and the tilt to small cap domestically. But longer term, as I said, that's done great for you over the past 5 years, nearly a 10% return, over 100 basis points above your bench, which has been excellent. And is one of the reasons why you've seen your funding improve so much over the past 5 years. And the good news is, as we go through down periods like now, you've got quite a bit of gains that you're going to able to smooth out some of these down periods here going forward because of that strong past performance. If I just go down to the next page. So as we go through the managers here, I'm actually going to give you some flavor of how all of your managers have done actually through the beginning of this week too. So I thought that'd be useful, noting all the volatility gone on in the markets. But I will note, previous page there, you saw at the end of February, we're at 666 million. And I think Chris mentioned as of today, you're at 664 million. So, things have, the fund is not sold off as much as if you're just watching the day-to-day markets on Bloomberg, you may have thought, you might be down a bit more. You really aren't at this point. So if we look at the fixed income managers, at this point, as I said, your core plus managers are looking more like a core benchmark, just because of the fear of maybe some, more stress in the markets as the year goes on. And your core managers, again, are also looking a little bit more like the benchmark, but none more than Barksdale. As you know, they're never more than 10 or 20 bits off the bench. They're, out of all your managers, they're the one that actually has at bench treasury in there as well, which obviously helps when equities go down. And no surprise, year to date, they're pretty much right on benchmark. 2.1% so far here in 2025. MetLife, your core plus manager, if you look at their 1 year number, great outperformance because of that sub-investment grade impact that you saw last year. However, that like most core plus managers at this point, they've really lowered their allocations to those areas, noting spreads are extremely tight. And therefore, as you can see, that 1 month they were pretty much in line. And that 2.3% number, what you see for the month of Feb, year to date, that is what they've posted, just a little ahead of the aggregate bond. If we go, and then on the credit portfolio, again, you can see longer term credit, 1 year, nearly 8%. They did lean to a little bit more of an overweight, the triple Bs, the lower quality part of the investment grade area. That's been accretive more longer term. But again, now they've moved up the quality spectrum a little bit more. So now they're looking more so like the index, and they're up 2.2 so far this year to date. And then Garcia Hamilton, as you know, they have about 50% of their portfolios in mortgages. Historically, they've been benchmarked the intermediate of cred, but we've now asked them to manage against the aggregate bond, and you can see why there. That 1 month return, it's exactly the same as the aggregate bond because that's how they're more invested like, and they've had a great year for you so far. They're up 2.4% year to date relative to the ag of 2.2. So all your kind of investment grade managers are doing very well and are giving you some of that protection in the equity down market this year. The one that's lagged just a little bit has been Sky Harbor. As you can see, just up 50 bips here for the month of Feb. And actually year to date, that's been their performance. They're up 50 basis points, just a little behind the bench, but obviously below core bonds because we're in a bit of a risk off environment this year. If we go, oh, you know, I didn't even have it on returns, did we? They were the returns. Sorry, that you saw there. If we go onto your equities, and this is where the domestic equities where the kind of relative performance story can be seen. If you look at the top line there, your composite, as you can see, actually going back in time, you will actually lagged your composite. But more importantly, if you look the past 3 months, you can see you're quite a bit behind the composite there. And you might scratch your head a little and say, why? If we look at the large cap composite and we look at the small cap composite, both of the composites are actually in line with the benchmark. You know, the managers are pretty much in line with what you would expect. So that underperformance you see in there is purely because of the overweight you currently have to small cap stocks. So that's what's creating that tracking error there. And so as we look under the hood here at large cap, most of it's indexed, and yeah, both Rumline and Northern Trust are managing very close to index for you. And then PineBridge is more of an enhanced indexed approach. So it has about half the number of names of the benchmark. Does lean a little bit more to the growth side of things, and that is why more recently you've seen them lag so far this year. So they're down about 180 bips over the past 3 months relative to the bench of down 1. One sort of positive from them, as you know, they're going through that transition of that portfolio out of the company. They are reporting to me every month, you know, flows, because we're keeping an eye on that, noting that one of the investors in that fund has been allocated about 85% of that strategy. So we were very closely monitoring it. There've been no flows out of that fund so far this year. There's actually been positive flows in. So nothing of concern there. And then if we look at small cap, I think the question we were asked at the last meeting, Copeland were lagging last year. And I believe, Don, you asked a great question. You know, when would you expect Copeland to be ahead? And I said, well, you would expect them to give you better protection in down markets when dividends give you some protection. And that is exactly what is playing out this year. And you can see for that sell-off that we saw in February, your small cap dividend growth was down 3.6 relative to the bench, down 5.3. As we sit here through the beginning of this week, the fund Copeland were down 6%, whereas the small cap index is down 7%. So you got about 100 basis points better protection, at least on the downside there, from that protection from the dividends. Now, noting you only have a 2-asset portfolio here, one thing that you guys might consider noting that also you have quite a bit of a over allocation of small cap relative to the domestic equity bench. Is Copeland actually managed this strategy in a SMID cap for you too. So what that means is they're able to buy some mid cap names for you. And as you can imagine, there's a few more mid cap names that pay dividends than they are smaller cap. So it sort of widens that pond for you a little bit. So you have less concentration risk. You're less capacity constrained too, because you're moving up the market cap. Tends to give you over a full cycle, there's very little in return between the two. But if you look at pattern of return, it's the down markets where the mid cap, that extra market cap, gives you a bit more protection. And as you sit here today, the SMID cap is only down 3.6 relative to down 6 for the small cap. So again, it's just something to be mindful of. It does have less turnover as well than the small cap. So you know, for your SMA to be a lower investment implementation cost. And more importantly, Copeland will tend to offer a lower fee for SMID cap too. So all being all, you know, that might be something you guys might want to consider for the future. If you want to take some of that small cap overweight off, it may be something you're able to do pretty simply just by changing in the Schedule A, the benchmark that these guys are managing to. And then just the final page here for me on the international. Both of your active managers here, you know, long-term have been great for your fund, added a lot of alpha, predominantly been driven by stock selection. And as we sit here year to date with US markets down, I'm happy to say Acadian is up 8.6% year to date for you, slightly above the bench of 8.5. They're a little behind what Ernest has posted. Ernest is up 9.4 relative to 8.5 so far year to date. And that's just because Acadian is more of an all cap approach, so has a little bit more small cap there. And that's been lagging large cap so far this year. But say longer term, your international composite there has really been accretive to your pool. So a lot to digest, but any questions? And again, my apologies for earlier.
Thank you, Lee.
Thank you. Yeah, thank you for that presentation.
Let me stop sharing.
Don, in terms of new business, I don't have any other than to note the next meeting is at 9:30 on May 14th. Should have received an invite for that. But certainly if the commissioners have any other questions or things they need to discuss before we wrap up, by all means.
Thank you, Christopher. Anything else commissioners would like to put on the table before we conclude?
Yes, I missed it and I have to look back through, but what kind of cash do we have on hand?
12.5 million. So roughly 4.5, maybe 5 months of benefit payments. They've increased slightly. I think they're up to about 2.7, Bill, maybe 2.8. So I well, anticipating where you might be going with the question, but obviously if I'm wrong, tell me. Definitely something I'm keeping an eye on along with Marquette. And if we see, you know, a slight uptick and perhaps the opportunity to raise a bit more cash, I'm likely to take it. Of course, we'll keep, you know, controller's office, Rob, Fran, and Don up to date. But that is something I'm being mindful of during the market volatility.
As always, insightful, know where I'm headed. Thank you very much.
All right. I
appreciate
thought
that.
that's where you're headed.
Yeah, I want to be, you know, as an interested party, I just want to make sure there's money set aside for benefits to be paid out before we have to liquidate any of the assets with Lee's overview of where we just were.
Yeah, definitely something Alberto and Lee and Quaco and I are keeping an eye on, and I will of course keep you updated before, you know, making any transactions like that.
Okay, thank you.
Before everyone drops off, may I ask that I get everyone to state their position, please?
For the transcript.
Yes, please.
I'm Christy
Sharon
Brady.
Scott,
Team Control.
Chairman.
Would it be helpful to drop it in the chat?
Francis Bialy, I'm the designee for the finance director.
We have Christy Brady, the city controller, Bill Rubin, who's the first deputy city controller. Fran provided his title. Don Scott is the chairman. We have Adam Coleman and Dan Gordon, who are both attorneys with the city law department. Lee Martin and Alberto Rivera, who are with the consulting team at Marquette Associates. And John and Dan from PGW, I don't know your titles if you want to state those for the file.
Or Dan Leonard, Vice President and Controller for PW.
John Sherman, Treasury Analyst, PGW.
Thank you so much. I appreciate that. All right.
Thank you.
Thank you all.
Anything
you.
else that we need to cover
Thanks, everyone.
before we,
No, I think we're good.
all right. Is there a motion to adjourn?
Make a motion to adjourn.
So moved. Thank you very much.
Thanks,
Thank you.
everyone.
Thanks.
Have a good day.
Great day.
Thank you.
Thank you.